Mixing expenses between multiple businesses, also known as commingling, can have some pros and cons. Today, we're going to talk about some advantages and disadvantages of this practice. Some of the pros are the simplicity and convenience that is obvious. Using one account to pay the bills for multiple businesses can be more straightforward and convenient, especially if the businesses are closely related or if you are the sole owner of all the businesses. It may reduce your administrative burden and simplify your bill paying processes. Cash flow management. If one of your businesses is experiencing a cash flow surplus while the other may be facing a deficit, commingling expenses can help balance the cash flow between the businesses and ensure that your bills are paid on time. Economies of scale. Combining expenses can lead to potential cost savings, as you may be able to negotiate better deals or discounts with your vendors by bundling your purchasing power. And tax deductions. Some expenses, such as shared office space, utilities, equipment, are often shared among businesses with the same owner. However, the following cons are worth noting. Legal and tax implications. Commingling expenses can create legal and tax complications. If the businesses are separate legal entities, mixing those expenses can blur the lines between them, potentially jeopardizing the liability protection that comes with having separate business structures. Bookkeeping complexity. Commingling expenses can complicate bookkeeping and make it difficult to track and allocate expenses accurately to each business. It will inevitably cause more transactions to become necessary to properly document the money movement, and this can lead to errors in financial reporting and tax filings. Risk of audits. The IRS and other tax authorities may scrutinize businesses that commingle expenses, especially if it appears to be done to manipulate tax liabilities. And this can lead to audits and potential penalties if improper accounting practices are discovered. Loss of financial visibility. Commingling expenses can make it challenging to assess the financial performance of each business accurately. This lack of clarity can negatively impact decision-making and strategic planning. And lack of separation. Mixing expenses can weaken the distinction between your personal finances and business finances, potentially causing personal liability issues. Investor and lender concerns. Investors and lenders may view commingling as a lack of financial discipline and transparency, which can impact their willingness to invest or provide funding to the businesses. At the end of the day, while commingling expenses might seem like a convenient approach, especially for closely related businesses, the disadvantages and potential legal and financial risks usually outweigh the benefits. It's simply best to maintain clear separation between the finances of each business that you own, ensuring proper accounting practices and compliance with legal and tax requirements for each entity. It's best to consult with a qualified accountant to develop a suitable budget and/or bookkeeping strategy for your multiple businesses. We hope you found this information helpful. Subscribe to our channel for more videos like this and share with someone else who may find this information helpful. We'll see you on the next video.